Do you believe in a free market economy? Prepare to be shocked by how far politicians will go to manipulate the markets if it suits their dastardly purposes. Hello, I'm Graham Rowan, the renegade investor cutting through the crap to bring you what's really going on in the world of wealth creation and wealth protection. Today, I want to talk about the news behind the news and how one government is determined to manipulate the gold market. When we witnessed the big drop in gold and silver prices back in April, I mentioned the way banks like JP Morgan were deliberately manipulating the so-called paper market by issuing huge sell orders on more silver than could be mined in a whole year. They forced prices down. And yet demand for the physical metal soared to the extent that the US and Canadian mints ran out of stock. Given the inherent worthlessness of fiat currencies around the world, I suppose we shouldn't be surprised that governments also want to manipulate the price of gold and silver to make them seem unattractive to their citizens. Perhaps the most blatant example of this can be seen in the actions of the Indian government so far this year. Traditionally, India is one of the countries with the strongest demand for physical gold. But just look at the steps the government has been taking to try and suppress that demand. It's so blatant that Reuters has actually compiled a list. In January, the government raises the gold import duty by 2% to 6% and doubles the duty on raw gold to 5%. The finance minister says there are no plans for further increases in duties. In February, the Reserve Bank of India announces plans to introduce gold-based paper ETFs to get people out of the habit of buying the physical metal and into the much more easily manipulated paper market. The bank then says it may impose restrictions on the value and quantity of physical gold that banks are allowed to import into India. Still in February, the Trade Ministry recommends suspending cheaper gold jewellery imports from Thailand and puts in a transaction tax of 0.01% on non-agricultural future contracts, which of course includes precious metals. It still isn't working, so in March, the finance minister appeals to people not to buy so much gold. And later that month, the Reserve Bank says it's examining banks that sell gold coins and wealth management products to identify systemic issues with a view to closing any legal loopholes. In April, the finance minister says it's unlikely the government will raise the import tax on gold further and would instead introduce inflation-indexed instruments. In May, the Reserve Bank restricts the import of gold on a consignment basis by banks. In June, the finance minister says that India cannot afford the high levels of gold imports and may review its import policy. And later in June, despite the earlier promises, India hikes the gold import duty by 1/3 to 8%. Now the biggest Jewelers Association is asking its members to stop selling gold bars and coins. They represent about 35% of a jeweller's business, and this is a ban that could go on for 6 months. So what have been the results of this blatant interference in the market? I'm delighted to say that like most politicians' attempts to manipulate economic forces, they've achieved exactly the opposite of what they set out to do. Gold imports surged 23% in January and had a 41% increase year on year in the last quarter of 2012. In April and May, imports of 152 tons were more than double those of a year earlier. Premiums have doubled as suppliers struggle to meet demand for physical gold. So what does all this mean for us as gold and silver investors? I think there are 3 lessons we have to take on board. First, recognize why the powers that be are motivated to manipulate these prices. Accept the inevitable volatility that this will cause. Jim Rogers thinks it could go as low as $900 an ounce before gold rebounds big time towards the end of the decade. Secondly, stick to your core belief that there will be a meltdown of fiat currencies at some point, even if we can't predict whether that will be in 6 months or 6 years. And thirdly, drip feed your investment on a monthly basis to take advantage of volatility so you buy more when it's cheap. And most of all, remember, be careful out there. Thanks for watching. If you've enjoyed what you've seen and you want to see more, why not click here to subscribe? And if you're one of those saddos that spends your life playing with all that social stuff, why not like us on Facebook or follow us on Twitter? See you next time.